Good morning. The 2026 commercial real estate financing predictions for savvy borrowers and brokers. Welcome. If you're a real estate investor, a developer, a builder, a commercial mortgage borrower, or even a mortgage broker working those markets, you'll want to pay close attention to what's coming in 2026. And this post will dive into what's shaping commercial real estate or CRE financing, what to expect next year, and how you and your clients can prepare. And as always, we'll bring you a practical lens for borrowers, lenders, and referral partners in the capital market space. And here's the 2026 financing backdrop. CRE financing landscape is entering a truly pivotal year, and here are some key backdrop items to think about. There's a massive maturity wave coming. More than 1.5 trillion in commercial real estate loans are coming due by the end of 2026, creating a refinancing bottleneck. And lending activity is ramping. The Mortgage Bankers Association, or MBA, projects total commercial and multifamily originations to reach 709 billion in 26, up from 583 in 2025. Capital is becoming more selective. While debt availability is improving, lenders remain highly selective regarding asset quality, property type, as well as sponsor strength. So asset class performances are diverging a little bit. So sectors such as industrial or logistics and data centers are stronger, while traditional office and some smaller retail face their headwinds at the moment. So here's 5 key predictions for 2026 financing. And here are those 5 major financing trends that you should be ready for in 26, especially from a mortgage broker's vantage point. Number one, there's refinancing pressure and a maturity wall is becoming reality. The end of extended pretend. With trillions of dollars coming due, many borrowers will face either higher interest or lower proceeds or need additional equity infusion to make deals work. And here's the broker tip. Encourage clients to engage early, review maturity dates and access exit strategies, and also explore alternative lenders now. Number two, capital's flowing but favoring quality assets. So originations are increasing, but the focus is shifting to lower risk properties, stronger markets, and sponsors capable of actually executing. And here's the broker tip. You help clients highlight occupancy trends, tenant diversification, as well as sponsor track record. And we can emphasize properties in stable or growth markets. So think a Sunbelt area or industrial logistics right now versus weaker tertiary markets. Number three, rates and spreads stay elevated but may moderate. Although long-term rates may ease modestly, borrowers who locked in very low rates will still feel pressure when needing to refinance into higher cost debt. And here's the broker tip. Run your amortization and cash flow models for your clients, especially under higher rate scenarios. Emphasize direct debt service coverage margins and stress tests for future rate increases. Number four is the growth of alternative lending channels. So banks still remain cautious, but private credit funds and non-bank lenders are creating structures and are stepping in. Here's the broker tip. Position yourself as an advisor who's fluent with non-traditional lenders. Think CMBS, credit and debt funds, or mezzanine debt. And that can help you match clients to broader capital sources. Number five, ESG, modernization, and tech-driven assets will benefit. As assets requiring major retrofit, especially older office buildings, because they face risk of obsolescence, lenders will reward properties with future-proofing, ESG credentials, and strong tenant demand. So here's the broker tip. For clients owning older assets, advise on strategies for repositioning those, upgrade their budgets and capital planning. Highlight how doing so may unlock better loan terms or more favorable financing. So here's some specific implication for your mortgage brokerage and referral network. Since your focus is on commercial mortgage through Medallion Mortgage or Medallion Funds, with Houston and Katy, Texas as our client tenant base, here's how you can apply some of these insights. So think borrower education, craft co-marketing materials with your referral partners, real estate brokers, builders, investors, and explain that there's a coming maturity wave and stress the refinancing urgency. Loan product readiness. Be ready to present not just standard bank debt, but also mezzanine, bridge, and alternative credit source debt. And highlight your relationships with non bank lenders who specialize in these markets. So you also see some targeted sector lending. So focus on strong asset classes. So think in Houston or the Sunbelt region, industrial logistics or data center adjacent properties, supply chain, warehousing, and multifamily and growing markets will help your clients position for better terms. So sponsor strength and documentation. Encourage your borrowers to maintain clean financials, stable occupancy, and strong asset management plans. Lenders going to be picky, but we can get this done. And also highlight your forecasting and advisory role. Your value comes when you act as a strategic advisor, not just a transaction broker. Help clients model out financing options, exit strategies, and refinance stress tests. So here are the key takeaways for 26. Massive refinancing volume equals pressure, but also opportunities for brokers who move early. And debt capital is returning, but under strict underwriting and quality counts. Rates may moderate slightly, but borrowers refinancing from ultra low rates will still feel pain. Now, alternative lending channels will play a larger role, so be ready to navigate them. And also think about asset differentiation via ESG, modernization, and evolving tenant demand, and how that could influence financing terms. Your role, as always, educate, advise, and connect the capital. And here are the final thoughts. 2026 isn't simply a repeat of past cycles. These structural shifts in how assets are used, think office and remote work, as well as the rise of logistics, combined with large maturity volumes and evolving capital sources, mean that brokers and borrowers must think proactively. And at Medallion Mortgage and Medallion Funds, we're positioned to help clients navigate this evolving landscape. So let's connect and make sure your financing strategy isn't reactive in 26. It's got to be proactive and aligned for success. That, my friends, is it for the day. Hope you have a good weekend. We'll see you Monday.